All right, well, welcome back. I hope everybody had a good Thanksgiving break. Hopefully you got plenty to eat and nice time off. Let's look at a couple of announcements here. So your 14th and final homework assignment is due on Wednesday. So you've got 2 more days to finish that. All of the information that's included on that assignment we covered before Thanksgiving, and so you've got everything you need as far as in-class exercise and lecture material to delve into that assignment. And then once you submit the homework, then the only remaining thing on our schedule then is the final exam, Tuesday the 8th. And the situation with that is going to be very similar to how we've done our earlier midterm exams, where there's going to be a 2-hour period during which the exam will be posted on Blackboard. And so you can download it, print it out, or you can work it just from the screen, and then you'll submit the PDF file back to Blackboard before the 12:15 deadline. And the exam is comprehensive. It would be tough to give an exam that wasn't in this course, where the material kind of naturally builds on itself. But there will be added emphasis on topics that have been covered after our second midterm exam. And so what that means is that there may be proportionally more points and more coverage to the material since class number 30 and onwards. And so remember, you've got a copy of the course schedule, and if you don't already have that printed out, it's available on Blackboard. And so you can look at each lecture, what was the topic for that class meeting, and the exam is comprehensive, but there will be more of the points that come from the later material. All right, so what we're going to do, just to begin with, I was looking at the course evaluations, and I can't see the results of the evaluations until a few days after the semester is over, but what I can see is how many students have submitted the evaluations. And so far, it's not very many for this class. And I really value student feedback. I'd be interested to know how you think it went this semester. And of course, in a lot of ways, this semester is just an unmitigated disaster because we didn't get to see each other, we didn't get to work in the same classroom together, and so, you know, it's just been damage control since day one. But I've honestly been pretty impressed with how much students seem to have learned in spite of the challenges. And so this is just another chance for me to get some feedback on if you've got any tips for how the course could be improved, or if there are certain things you'd like or don't like during the semester. You know, for instance, do you think the in-class exercise are worth the time, or do you think that there should be like more lecture and less problem solving? So I'm eager to have your feedback. And so what I'm going to do is I'm going to pause for a moment so that you can go into MyMU. So to get to the course evaluations, the first thing you need to go to is MyMU, mymu.marshall.edu. And then when you go to that, look for the Student tab. And then under the Student tab, there is a Student Resources menu. And then finally, Course Eval. And I'm not so concerned that you do it for all of your classes. What I really care about is that you do this for my class, because I'd love to have your feedback. So I'm going to pause for 5 or 6 minutes and give you a chance to enter your feedback, and then we're going to get into depreciation. So I'll stop talking, and then 5 minutes we'll get back into it. Well, all right. If you're still working on those evaluations, please continue. I'm happy to have as much feedback as you're interested to give me. This is one of my favorite classes to teach, and so hopefully you get a sense for my enthusiasm. I really like this material, and so if there's any ideas you've got of ways to make it even better, I'm eager to hear it. All right, so we're going to talk about depreciation today, starting in Chapter 16. And by the way, regarding the projects, I've got about halfway through grading those. And as you can imagine, it's a lot because you've put a lot of effort into it individually, and we've got more than 40 students in the class. And so I'm going to be continuing to work through those this coming week. I'll definitely have them graded by Friday, but I'm hoping that I'll have them graded even sooner than that. Okay, so depreciation. As you may expect, this old Honda is worth a lot less than a brand new Honda. I mean, unless maybe you were considering the collectability of the first Honda Civic that was ever sold. But in general, everybody's familiar with the trend that cars and lots of other things lose value over time. In fact, I've talked about it before, how I'm toying with the idea of getting a Porsche, but now I'm definitely not going to be getting a Porsche. I never really was, but just thinking about having to repair that twin turbo, it freaks me out. But as far as depreciation goes, the decrease in value of physical properties over time. And it can be cars, it can be machines that are used to produce things. It can be essentially a lot of different categories of equipment, and we'll talk about the types of things that can depreciate. But one of the main reasons that we're interested in characterizing and calculating depreciation is that it allows companies to deduct the value of depreciation against their earnings for the year. And so, for example, if a company has a profit of $1 million in a year, but during that same year their equipment lost $500,000 worth of value, then what that means is that they only need to pay taxes on $500,000 instead of the full million. It doesn't mean that their taxes are reduced by $500,000. It just means that their taxable income is decreased. And so depreciation is valuable for companies because it reduces the amount of tax that they have to pay. Now, when calculating depreciation, there's some terminology that's important for us, and one of the first terms that we have to keep track of is how much it initially cost to buy the equipment and put it into service. And so that's the cost basis. And it includes both the sales tax you have to pay, the asset's initial purchase price, and then any kind of additional fees required to actually put it into use. And so that could be the installation costs, the transportation. It may even include some operator training expenses that's required to put that item into service. And so that's the initial cost basis for the equipment. Now, the book value is what you'll calculate in any given year, and it represents how much that still has on an accounting basis in value. And it doesn't necessarily mean that that's what the item would sell for on the open market. So book value and the actual resale value of an item could differ quite a lot. The book value is just where you have taken the initial cost basis and subtracted out all of the cumulative depreciation up to a certain time. And then what's left is the book value at a certain year. Now, not everything qualifies for depreciation. So there are certain things that allow you to include or exclude items for depreciation. And you have to have something held to produce income in order for it to be depreciable. And so you as an individual, if you buy a couch for your house and a television, it could meet all of the other criteria, but if you're not using it for business purposes in order to generate income, then you can't depreciate it. So it shouldn't just be personally owned property that you're using for your personal benefit. It should be used in a business way. The second requirement for property to be considered depreciable is that it has to be a durable item with a useful life of longer than a year. And so, some pieces of, some things that you may buy, like paper, printer paper, wouldn't be depreciable, partly because its useful life is shorter than a year. It has to be something that wears out, and so it can't be something like a diamond. Even if you were owning a diamond for business purposes, the diamond, if it doesn't decay, then it doesn't depreciate, because depreciation is meant to represent the loss of value over time for an item. It also shouldn't be the inventory that you're going to be selling. And so a car dealer who has a bunch of cars on their lot, even if those vehicles are losing value as they sit on the lot over time, the inventory can't be depreciated. And so remember that what companies are trying to do is they're trying to maximize the amount of equipment that they own that gets to be depreciated, and they also are trying to accelerate the depreciation to be as soon as possible, because the earlier they get to depreciate the equipment, the more valuable those dollars are, because a dollar now is more valuable than a dollar in 1 year or 2 years or any amount of time in the future, because what we know is that prices are increasing over time and the value of a dollar is decreasing over time. And so businesses want to depreciate their equipment, and they want it to depreciate as quickly as possible. So there's all sorts of accounting, not necessarily gimmicks, but accounting practices that are used so that companies can maximize their depreciation and therefore reduce the income taxes that they have to pay. Now, there are 3 different methods to calculate depreciation that we're going to talk about this semester. And today we're going to cover 2 of those methods, and then in Wednesday's class we'll discuss the third. So the first 2 methods for depreciation include straight line depreciation, and then declining balance is the other. Now, straight line depreciation has an equal amount in terms of a dollar value of reduction in value each year. And so it's called straight line because if we do a graphical representation of the book value of the equipment that's depreciating, then you'll notice that the book values decrease year by year is linear. And in straight line depreciation, we can consider a salvage value. You don't have to. You can set the salvage value equal to 0, but you can also have a positive salvage value, assuming that at some future time the equipment is no longer suitable for business purposes, but maybe it still has some residual scrap value. And so straight line depreciation is probably the simplest approach for calculating the reduction in value over time. Now, declining balance, the other technique, is a little bit more complicated, but instead of having a fixed amount decrease each year, then it's a constant fraction of the value that decreases each year. And the idea with declining balance is that more of the depreciation happens in the earlier years than in the later years. And so rather than just assuming that you're losing, the same, maybe if it was a car, for instance, instead of assuming that you're losing $2,000 of book value every year, the declining balance method allows you to say that you have a big amount of depreciation in the first year, a little bit less in the second year, and so on and so forth. And you also can consider a salvage value in the declining balance as well. Now, the third depreciation method that we'll talk in more detail about on Wednesday is the MACRS. And it's also known as the General Depreciation System. And MACRS is Modified Accelerated Capital Recovery System. And that uses kind of a table of depreciation factors where you're not having to do as much on a calculation basis. But what does make that a little bit tricky is that every piece of equipment is classified according to a category. And different categories of equipment accelerate over different periods of time. So we'll talk about all the details of that in Wednesday's class and focus just on straight line and declining balance depreciation today. And so just to review some of this terminology that we've already covered and identify some alternate names that some of these things are talked about. The first cost of equipment, or the cost basis, is the total installed cost, including the installation, including the tax, including delivery charges, and so on. The book value is, in any given year T, it's the value of the equipment. And so that would be the cost basis minus however much depreciation has happened up until that time. The recovery period will be either specified in the problem statement, or you'll need to look it up based on the category of the equipment. And so that's how many years the item depreciates over. And what a company is hoping is that the N is as small as possible. Now, that's not to say that the company hopes that the equipment will actually physically wear out quickly. In fact, they want the opposite of that. They want the equipment to be as durable and last as long as possible, but on a tax basis, they want to have the useful life look like it's small so that they can take the depreciation sooner rather than later. The market value is different from the book value because the market value characterizes how much it's actually worth if it was going to be sold on a secondary market. And then, of course, the salvage value would just be an estimate of how much you expect to sell the item for at the end of its useful life, or if you're just going to be scrapping it, the value of the underlying raw materials. The depreciation rate, this lowercase d, is what we are going to be calculating in the declining balance method. And that's the one where instead of having a fixed dollar value reduction in the book value each year, it's a fixed fraction. Now, personal property can't be depreciated, and neither can real estate. So, for example, land can't be depreciated. And the half-year convention is something that we'll talk about on Wednesday. It has to do with the table for the GDS system, where it's assuming that you buy the item in the middle of the year. Because as you'll see, when we're using the straight line or declining balance method, there could be a way for companies to kind of game the system a little bit. And the trick would be, if you're going to be reporting your depreciation according to straight line or declining balance, if you buy the item at the end of December, technically the item is purchased in a given year, so you could take a full year of depreciation just for buying the item at the last day of the year, potentially. And so to avoid that, when most governments moved over to using a table of depreciation with the GDS, then they assumed a half-year convention. So we'll get into the details of that on Wednesday. Now here's the formula for straight line depreciation. And this is the one where there is a fixed dollar decrease each year in the book value of an item. And so the depreciation amount is calculated by knowing the initial purchase price of the item, so its first cost basis, and then subtracting out the salvage value, or the market value is another name for it, at the end of its useful life, and then dividing by the total number of years in the recovery period. And remember, N, recovery period, it may be the actual physical useful life of the item, but more importantly, it's the tax definition of how long the item is supposed to last. And so that's going to be kind of a policy or a government regulation decision on, for example, how many years vehicles should be depreciated over, or how many years a computer can be depreciated over, and so on. So this is a straight line depreciation approach. And you can calculate the book value in any year by the initial book value, the initial cost basis, and then minus the depreciation amount per year multiplied by the number of years. And so T is the number of years. And so if you're going to have 3 years of depreciation and you want to know what's the book value after 3 years, it would be the initial cost basis subtracting 3 years at depreciation per year. So this is the straight line approach, and it's relatively simple to calculate. We'll look at a quick example just to, if nothing else, show you why it's called the straight line method. So let's say that we have a piece of equipment, an argon gas processor, that has a first cost of $20,000. So that's the purchase price, the delivery, just all of the things required to put the item into service. And after 5 years, we know that that equipment is going to have a $5,000 salvage value. So we need to find, first of all, this is asking what is the depreciation amount in the 3rd year. Well, the depreciation amount in every year is going to be the same. That's straight line depreciation by definition. But we'll calculate it for the 3rd year, and it'll be the same as the depreciation amount in the 4th year, and so on. We also want to know what is the book value in year 3, and then we'll do a graphical representation of the book value versus time. So the depreciation amount in any given year, remember, is going to be the first cost minus the salvage value divided by the number of years. So here we've got 20,000. minus 5,000. So that means that it's going to be depreciating $15,000 over a course of 5 years. And so that means that every year we're assuming it's losing $3,000 worth of its value. So that's going to be 3,000 in the third year. It's going to lose 3,000 in the fourth year, in the fifth year. Every year it loses a fixed amount in terms of dollars. And so the book value in the third year, there's a couple of different ways you could calculate it. First of all, you could do it sequentially. And so you could say the book value initially is 20,000, and then at the end of the first year it would be 17,000. At the end of the second year it would be 14,000, and at the end of the third year, you could just subtract 3,000 each year, and so you could do a row by row approach. Or what this is suggesting is just say it's going to be 3 years of 3,000 per year. And so the total depreciation amount after 3 years is $9,000. So the book value after 3 years then would be 20,000 minus 9,000. So $11,000 of remaining book value exists after 3 years. And so this is now why you can see it's called straight line depreciation, because we start at its initial purchase price at time 0, and then the item is decreasing in value linearly. And so if you're going to plot the book value over time, it's a straight line. Okay, so relatively simple concept there with straight line depreciation. Any questions before we continue and take a look at a declining balance example? Okay, so declining balance is a fixed percentage decrease each year. And businesses would prefer this over straight line depreciation because more of the depreciation happens early on. And that's actually a more realistic representation of what happens for most equipment. Most equipment lose a greater fraction of its value in the early years than it does in the later years of the equipment life. The maxed rate for this fraction is twice the straight line rate. So the depreciation can be twice as steep as a straight line depreciation would be, and we can't go below a salvage value. So the way that you would calculate the depreciation amount is it's going to be the D, which is the percentage depreciation factor, multiplied by the previous year's book value. And so if you're going to find the depreciation in year T, for example, let's say you want to know the depreciation in year 2, how much will be lost in the second year? It would be this factor that stays the same multiplied by the book value in year 1. So that would be T minus 1. So the previous year's book value is how you calculate this year's depreciation. Now there's two different ways that we can calculate this depreciation factor, lowercase d. And one is sometimes a problem statement will tell you percentage depreciation. So maybe they would say it's 200% depreciation. And what that would mean if it said 200% depreciation is that the first year's depreciation amount is double what straight line depreciation would be. So that's one way, is that we can calculate lowercase d depreciation factor as a percentage. Or another approach is if we know what the salvage value will be after a certain number of years, then you can calculate the depreciation factor by knowing the initial cost basis and the salvage value, and then n is the number of years that it depreciates over. So these are two different approaches, and the problem statement will tell you either a salvage value, and if it does, then you calculate d with this equation on the right, or the problem would give you a percentage, and then you'd calculate d using this formula on the left. And then the book value for any given year can either be calculated sequentially, like I was just mentioning for the straight line method, so you can be kind of row by row, or you can calculate the book value directly for any year by kind of accumulating the overall depreciation with this exponent factor where t is the number of years. Okay, so let's take a look at both of these two different approaches. And so a percentage depreciation being specified, and then what if a salvage value is given. So we're going to first talk about it's a truck that has a first cost of $80,000, and we know that it lasts for 10 years. And so n equals 10. And we want to know how does the depreciation and the book value over time look according to either of these strategies. Now I'm going to use a spreadsheet for this, and you don't necessarily have to use a spreadsheet, but if you're doing it for 10 years and we want to know what's the book value for each of the 10 years, things would get a little bit repetitive if we weren't using a spreadsheet. So here's how you could set it up. For the part A, where you're using a percentage, you'd have 150% is the given depreciation percentage. You can see n is 10 years. We have an initial book value, but in part A, there's no known salvage value. That's not what we're starting off in knowing. So the way that you calculate D, the lowercase d depreciation factor, is with the percentage divided by 100 times 10. 100 times n, where in this case n is 10 years. So it's 150 divided by, in this example, 1,000 gives you a factor of 0.15. So what that means is each year's depreciation is 15% of the previous year's book value. So look at the depreciation amount in year one of $12,000. 12,000 is 15% of the book value. And so now, how did we come up with this depreciation amount in year two? 10,200. That is 15% of the previous year's book value. And so row by row, what we're doing is the book value for each year is the previous year's book value minus this year's depreciation. So then the 57,800 is the previous year's book value. So that's the cell above it, minus the depreciation amount for this year. And so we go on and on until we see at the end of the 10-year the book value after all of the depreciation has occurred. So this is an example of how you do it with a percentage. Now in the case of the salvage value being defined, we calculate the depreciation factor slightly different. Rather than using this percentage formula, we'd calculate the depreciation factor with 1 minus s divided by b, so that's 1/8 to the power of 1 divided by 10. So we get the depreciation factor using this formula, and then row by row is calculated kind of the same way, where we start off with some known book value. The depreciation amount is, in this case, 18.77% of the previous year's book value, and this year's book value is calculated by the previous year's book value minus the depreciation amount for this year. And then we repeat the pattern all the way down through 10 years. So that's an illustration of how we can do the declining balance calculations. So we're going to start off today's in-class exercise with straight line depreciation. And here is the in-class exercise that we're going to do to begin. Let me bring it all up on the screen so that you can see it at once. And I can zoom in a little. All right. Now, for this one, we're going to use Excel for part 2, but for part 1, solve this with just by hand. There's 3 different items: a loader, a mixer, and a crusher. And you can see that they each have their own individual first cost, a certain number of years for the recovery period, and a known salvage value. And so you can calculate the depreciation amount for each year with this formula. And so it's going to be different for each of them, since they each have their own different cost basis, a different salvage value, a different recovery period, and so on. And then calculate the book value with this formula. So question A is, how much total depreciation is there in year 1? Meaning, what's the depreciation amount for each of the items, and then combine it together. Part B, the total book value for all of the equipment at the end of year 3. So this time calculating the book value, it would be the initial book value for each piece of equipment minus 3 years and then the depreciation amount per year. So let me pause for a second and give you a chance to address these 4 questions, and you can type your guesses to each of those into the chat area, and I'll let you know if you're on track, and we'll look at the solution together. Okay, so the question is asking how much total depreciation is there in the first year. And so in the first year, each of the items is contributing to the depreciation because none of them have run through their entire recovery period yet. And so we've got 5,342 for the loader, 6,475 for the mixer, the crusher is 9,955. So the sum total of depreciation in the first year then is $21,773.40. So that's the total depreciation in the first year. Now, Part B asks what's the total book value of the equipment at the end of year 3. So to calculate that, we're going to have to know what was the initial book value of each piece of equipment and then subtract out 3 years of depreciation. So you can see that we've got the loader's initial value, the mixer's initial value, the crusher's initial value, and then we subtract out 3 years worth of depreciation by multiplying 3 by the depreciation amount per year. So then the sum total of the book value is that it's $121,179 at the end of the 3rd year. Now things are a little bit different at the end of the 5th year because the mixer has no more book value remaining. So we see that it goes to a salvage value of 0 in 4 years. And so it's already burned through all of its depreciation after the 5-year period. And so all that's contributing to the book value at the end of year 5 is only the loader and the crusher. And so the cumulative book value would be the initial basis for each of them minus 5 years of depreciation for each. So 107. And then finally at the year 8, it's asking how much depreciation is there. The only item that's still depreciating in year 8 is the crusher. And it's continuing to lose the same amount every year, and so it's losing $99.55 each year, including during the 8th. So that would be its depreciation in year 8. Okay, now moving on to the declining balance. This one can be solved either by Excel or by hand, and I'll bring up the pattern that I showed you before, just in case you want to refresh your memory of what that looked like in the previous example that I showed you. And so this one, you can either do, well, both. You're going to do according to the declining balance approach where a fixed percentage is specified. And then the second way of doing this is to find out if you use the salvage value and calculating the depreciation factor with that. So what we have is a roadway paving machine with a first cost of $486,000 and an 8-year lifespan for depreciation purposes, and we're going to calculate the depreciation amount and book value for all 3 of the for years 1, 2, and 3 if you're solving by hand, or if you're doing it with a spreadsheet, it's no problem just to automate through all 8 years. All right, so let me show you what this looked like when we had set it up before as a spreadsheet template. That's a little bit small. Okay. I'm going to copy this over to here. So what I suggest you do is you put these side by side. And We're going to do 150% on this example, just like the earlier example, but this time the N value is 8 years rather than 10. And so you can put in the initial cost basis. Of course, in Part A, there won't be a salvage value. You're calculating D using the percentage approach. So N is going to be different, so D will be different than it was in the earlier example. But when you set up the row by row, you're going to have one column with the year that you're in, the depreciation amount for that year, and then the book value at the end of the year in question. So at time 0, the book value is just going to be the initial $486,000. But then after each successive year, it's going to lose a constant fraction of the previous year's book value. So I'll pause for a second and give you a few moments. I think probably Excel is the quickest and easiest way to set this up, but you can also do it by hand, and I'll show you both approaches in just a moment. All right, so if you set it up with a spreadsheet, then all right, here is the solution. N is 150, percentage is 150, N is 8, and so therefore the D factor is going to be 0.1875, and so that means each year's depreciation amount is 18.75% of the previous year's book value. And so it's going to eventually depreciate down to $92,305 because in each year the book value is going to be the previous year's book value minus the depreciation amount for that year. If we do things according to a fixed salvage value, though, then the way that we calculate the D factor, let me give you the formula for that one again. 1 minus S divided by B to the power of 1 divided by N. So in that case, it does depreciate down to the fixed salvage value, and that's not coincidental. What you essentially do is you calculate what is the depreciation factor required to get you to that certain specified book value at the end of the 8-year period. So we could do these calculations by hand as well. It's a little bit more clunky, so I've showed how you would calculate the depreciation amount and the book value for each of the first 3 years according to 150% declining balance approach. So you can see what technique you do is that the first year is to the power of 1, the second year it's the power of 2, the third year it's the power of 3, and so you're calculating the book value that way. Or if you're using the known salvage value, then the D factor is calculated a little bit differently, but the method of calculating the book value each year is kind of the same. We are out of time for today, so let me just refresh your memory that what you should be working on for our final homework submission on Wednesday is homework number 14. That's available now in Blackboard. I'm going to continue working through the projects, and hopefully I'll get those graded as quickly as I can. They're looking good so far. I'm pretty happy with how they've turned out. So I hope you have a great day, and I'll see you in class on Wednesday. Take care, everybody.